What is up, everybody? Logan here again with another video coming right at you. And today I'm joined with Vance, and we're going to walk through just the trades in general with the 0DTEs, everything we've been doing in the Discord since May 31st and right around that time to about now. And it's really interesting to see the market move the way it has, right? Like we're pretty relatively flat in that time frame, but we were still able to absolutely crush that time period. And for somebody, if you're brand new to the channel and watching this video, I do go over a lot of these trades, and we'll have the link to the spreadsheet down below if you guys want to actually look at every single trade, every single strike. Of course, you guys can come join the Discord if you want to trade with us live time. But that's basically everything we're going to talk about in this video today, is just going over the trades, taking a look at everything over the past few months and how the market decided to shake out for us. Because that's one thing as a trader, is you want to set goals and then you want to be able to hit those goals. But also at the same time, you have to be very flexible when it comes to the market, because this market likes to move and it can get a little hectic sometimes. So we're going to just show, a little bit more than I typically show. And of course, Vance always has his great data. So I really appreciate you coming on for another video, Vance.
Hey, not a problem, Logan. So yeah, we wanted to kind of give a snapshot of the trades that we've taken for really the past 6 months, 90 trades. So we're going to go over kind of the analytics of what happened and what we did. So I hopefully won't bore everybody too much with the math, but it's pretty spectacular, and I think that getting an in-depth look of really what can be done, the proof is in the pudding. So what we're going to do is we're going to start off with a snapshot of 2022, right? So if we look at the broader market, right, the S&P 500, since January 1, right, the total annualized returns as of yesterday was minus 13.17%, right? So if you had money in the S&P 500, you're longing SPY or any type of derivative that is based off of that, you're down. You're down 13% in the year. Maybe you're a NASDAQ person, you're into the Qs or one of those types of things. You're down even more. You're down 26% on the year. That's a lot of money, right? I mean, it's a quarter of the value, right? Tammy Chambliss, she is to some people the queen of the 0DTE movement, right? She's pretty popular. She's got a strategy that's out there where they sell extremely wide Delta 5 credit spreads. And this year, her setup has been wrecked repeatedly. So much to the fact that she had to put out another video midway through the year with a bunch of fixes to the strategy. Because what we're doing is we're going with a super wide spread that's off at the 5 deltas, and we're basically praying that they're not going to get hit. And for a while, she wasn't running with a stop loss. It was basically ride or die. And she, along with a lot of traders, were getting clapped. And yeah, that's one of the reasons why we're doing this, to show you there's a different way, there's a better way. Now, my opinion is that she's probably a lot like Han Solo, where she's going to say, never tell me the odds, because that's kind of what the setup is we're just going to put on something. We're not going to really analyze the environment. We're just going to go. So we're going to talk really about why we do the EM trade setup and where these numbers come from and how they work out. So if you haven't watched any of our videos before, basically we do an EM trade setup, right? Now, the list of trades I'm going to show you right now are from May 31st, 2022 to the last day in November. We didn't just pick arbitrary dates. That's really when we first adopted this strategy, and we've kind of fine-tuned it a little bit since then, right? So during the course of that time frame, we have a total of 90 trades. There are days we skipped, right? Because there are reasons to skip days, like on an FOMC day, or a day where we're expecting a big move, or if we happen to be caught in the middle of a roll, right? The trade is based on the expected move. It's not based on delta, right? So what that means is that we're not just going to go into a trade at 9:30 or 10:30 or at a certain point of time during the day and picking a certain strike because the delta is a certain number, right? That just is going to ultimately lead to failure. And it's why a lot of these setups that are delta based don't show positive expectancy, right? Our spreads are 5 or 10-point wide spreads. Generally, they're 5, but occasionally we will go into a 10-point wide, depending upon the premium or if we had to widen to do a roll, right? Unlike a lot of the other trade setups, Tammy's in particular, we don't put on an iron condor. We're taking either a call credit spread or put credit spread, right? Because what we want to do is we want to eliminate all directionality to the market, right? If you put on an iron condor, right, at the inception of the trade, you literally have to have the trade go up or the trade has to go down. If it doesn't do what you needed to do, right, if it doesn't sit still, right, you're going to get stopped out. You're going to lose money because it either has to go up or it has to go down. I'm sorry, we don't want to go up or go down, right? Not to say we won't put on an iron condor, right? We have hedged them by putting on condors, but we only do it if that conditional setup is there, right? The other big thing is we do not take automatic stop losses, right? We're not just going to put on a 3x stop and say, okay, we got in at 50 credit. If we hit $1.50, we're out. Stops and rolls are based on the market setup and market technicals, right? If you have a trade that goes against you momentarily, but you're looking at a support or resistance zone between you and your strikes, right? Even though you may be feeling a little bit of pressure, right? You got in at 40 cents, trades at like $1.30. You're a little bit past the 3x, but you're at a big resistance level. Stopping out might not and usually isn't the right thing to do. You stop, you analyze, you make a decision based on that. Give it some time for the trade to work, right? So let's talk about our trade performance metrics, right? Over the course of these 90 trades, 51.7% of our trades were PCSs, 48.3% of them were CCSs, right? That is a little bit skewed. I would expect in a non-bear market, it would probably be closer to 60-40, maybe 70-30, being the higher value being the PCS. But in this bear market, the opportunity for more call credit spreads presents itself. So that's to be somewhat understood. When we're going to talk about our win-loss tracking, and this is the part I think is going to flabbergast a lot of people. Of the 90 trades, 88 of them were wins and 2 of them were losses. Now I'm going to throw a caveat out here, right? We're not tracking rolls as independent trades, right? So if we have to roll a trade, but the result of the rolled trade is that the net trade resulted in credit, i.e. we made money as opposed to losing money, that's a win, right? So there were a couple instances where trade had to be rolled. It was stressed, we rolled it, but the outcome of that roll was of credit received and then it expired worthless. So it still counts as a win, right? The average entry by credit trade type. So what we're going to look at here is how much credit we're getting. The PCSs, we got 46 cents on average. The call credit spreads, we got 49, which again makes a little bit of sense because you do have to go a little bit closer to get the same credit on a call credit spread. So a lot of times the call credit spreads were closer to the money just to take advantage of the premium that was available. Closing debit value. So this is what we paid to close our trades, right? So in 49 of our trades, a little bit more than half, we didn't close, we let it expire worthless. Now, a function of this is that when we were starting off, that a lot of these trades or those particular trades were in the beginning few months, right? They were in like May, June, July. As time went on, what we discovered was that it was a little bit better to close them. And a lot of times we'll put a buy to close at 5 cents, right?
I don't
Go
want
ahead.
I don't want to cut you off here, but that's also a mental thing too for anybody who's like not a huge credit spread trader. Maybe you are. Let's say you have a trade you put on at 10:30 in the morning. and it's gotten down to 5 cents within an hour and a half. So you have 4 hours left of the market, right? From 12 to 4 Eastern. There's a mental thing where if you just take it off for that $5 and just go about your trading day, or you're looking at another setup, maybe swinging, there's just something to be said about, do you want to sit and have that risk on for those 4 hours that the market, because these are expiring today, you have extremely large gamma risk. Do you want to sit there and have that potentially come back and either work itself back up to a 20 cent, 25 cent, 30 cent debit to close, right? And maybe you didn't make very much that day. Or, a max loser can happen. I've had in my trading career probably 4 times where I end up actually taking a loss on a trade, where it was like a 3 to 4x credit loss on something that got down to 5 cents at one point, and it's like if somebody's into sports betting, you've probably had a couple bets where the team was up by 3 touchdowns or 2 touchdowns going into the fourth quarter and somehow lost the game, right? So if you're able to take that risk off, that is one reason why you'll see a lot of these trades get closed at 5 cents. Does it hurt the overall, P&L on it, because then you're paying commissions to close and then the debit back? Absolutely. But overall, if you're looking at the long term with the strategy, that's actually what you want to do, because your main goal should always be reducing risk as a trader, instead of like, what island am I going to buy with my trading profits? It should be, how do I get myself out of this position and back to the most proper like mental spot, but also proper account spot for you to either take another trade, or you can just call it good for the day, for the week, and you hit your goal. So I just wanted to chime in and say that real quick.
No, absolutely. And to your point, I can remember last year around this time, I think it was actually around December 12th, maybe the 17th. I don't know the exact date.
Mm-hmm.
But there was actually a trade that day where the market was running up. And I remember that I made a comment. I had a put credit spread on that day. And at one point the trade was like, I want to say it was 80 to 90 points out of the money.
Yeah.
And it was 5 cents to close. And I made a comment in the Discord. Someone had asked a question. I was like, oh, this is going to expire worthless. And I kid you not, that trade ended up in the money. The market sucked out like 90 points in the last hour.
Yep.
Just out of nowhere.
Yep.
And is it going to happen all the time? No. Are the odds in your favor? Usually, but to Logan's point, right? If you can close a trade at 12 o'clock or 1 o'clock in the afternoon for 5 cents, and it costs you $5 plus a couple dollars in commission, like that's like $7, $8, right? Would you sit around your job and get paid? Would you sit around a job for 4 hours to only get paid $8? Like I wouldn't, right? So that if you just look at it from a time risk, what's the value to you perspective, because you're going to be kind of worrying about the trade, or at least you hopefully will be.
Yeah.
Right. So just not to have to worry about that, not to have that mental anchor about a trade still being on is definitely good.
Seriously, like I've had so many times where I'd gone to a meeting that I had for 2 hours, and like I would forget I had a trade on, and you just get that like not even like sinking gut feeling, but you're like, oh my gosh, I haven't checked it. What if it's getting crushed, right? Like it's a real thing. Like it's even hard to go to the gym when you have trades on. Like I would sit between sets just watching the market, just to be like, all right, what's our strike price at right now? Like where is the market? Just
Yep.
going back and forth. And if you do that every day, you will become so mentally taxed by it that trading will feel more like a chore instead
Yep.
of something that you do to make money. And like you want to reduce the amount of stress in your life. That should be everybody's goal, right? Like
Yep.
stress, reduce your pain. And one way to do that when it comes to trading is just taking your risk off when you have the ability to and can still make decent money, because that should be your
Yep.
goal.
Absolutely.
Not to be right or wrong. That's the one thing Halcyon's always said that's like stuck with me more than anything is, as a trader, if you get your ego out of the way, right? Our goal is not to be right. it's to make money. So if you can take your ego out of it, you're a lot better at making decisions.
Absolutely. That's absolutely great advice.
Mm-hmm.
So you can see we had 3 trades. We closed with 15-cent debit, 1 for 20. We had anything that wasn't anything that was more than 20 cents. I just lumped into all others. 2 of those were the losses, right? Because they were higher. And then 2 of those were ones that we closed for a very small profit, because basically what happened is the trade wasn't really going against us, but we were going into like the last hour of the day, and there hadn't been any real decay, because it really hadn't moved against us. It moved against us at a rate where we weren't at risk, but the decay just wasn't going down. So we just cut the trade for essentially a small win, maybe a break even, just to preserve the capital and not have a loss in power hour.
Yep.
It should be noted that of those 2, right, they both ended up expiring worthless, so we could have held them.
Yep.
But discretion is the better part of valor. So
100%.
So when we talk about, so what we're going to do is we're going to show the actual performance of these trades across 3 different account setups, right? So the first one we're going to show you is a $100,000 account that trades $5,000 in risk, which is 5%, that does not compound. So what I mean by that is that it's going to trade $5,000 or 10 5 wides every single time we trade. Never goes any bigger than 10 contracts, right? The second setup is going to be, again, a 100,000 account that trades 5% in risk, but it compounds in time. So what that means is that for every $5,000 the account makes, it can add a contract to it, right? And the third setup this is probably more for a lot of the viewers that are out there closer to their account sizes, potentially, is dealing with a smaller account, which is going to be $5,000. Because the account is smaller, you have to risk a bigger amount, right? Because you can't do 5%, because you wouldn't be able to trade 1 contract at that point. So we're going to risk 25% in that account, and that'll compound over time. We will add. Now, I will say that for setup number 3, the account doesn't ever actually get to that point. But as the account were to grow to, let's say, like $25,000 or $50,000, what we would do is we would reduce that percentage risk by staying at a certain contract level for an increased period of time, right? So like once you hit 10 contracts, you just wouldn't add contracts at that point. You would just trade 10 contracts until you hit maybe the $100,000 account, and then you would be at that 5% risk level.
Mm-hmm.
So for setup number 1, right, which is the account that begins up with $100,000 in funds, right? That makes every trade is a max risk of $5,000. So this is our growth chart, right? And over the entire period of the trade, the account would grow from $100,000 to $125,490. That is an account growth of 25.49%. Now, you think back to that first slide we looked at, for this same time period, right? Or at least for this year, the S&P 500 was down 10%. Yeah. So if you had $100,000 in the S&P 500, you lost money. If you had $100,000 and you just traded 5% of it on this strategy, you made 25% account growth.
Yep. And one thing I want to step in and say, for anybody that doesn't know, you guys can go look back to June 1st. The markets currently, from the time that we have these trades tracked to the 30th of November, we found that the market was actually down 0.5% since then. So even if you invested your capital then, the market would be basically flat. And anybody who has been slowly purchasing positions throughout this year probably notices they haven't done very much, and just because the volatility has been going up and down quite a bit. But yeah, that is one thing. And then another thing for setting expectations, there's quite a few places in this chart where it's pretty much sideways for a few weeks, a few days, sitting in rolls, right? You'll see a drawdown if we had to pay a debit or got stopped out. But overall, trading should be long-term. So just because you got the short end of the stick on a couple trades that you're running, right, with your strategy, like doesn't mean you should ever give up with something that's working for you. So that's one thing, as you guys can see here, is like, yeah, there were a few weeks in there, right? Like probably a couple weeks in there where we sat in a roll. I remember in July, we sat in a roll for a good 10, 11 days before we took
Yep.
the position off. So there's a flat portion in the end of July. And I just remember that off the top of my head. But overall, right, the strategy with the way it is has been very nice to us throughout this time, taking the EM based trades.
Absolutely.
Sweet. Setup two.
Setup number two. So same kind of beginning entry, $100,000 in funds, right? Each trade risks 5%. That means we're going to start at $5,000, right? So here's this chart. Yep, it looks pretty much the same as the other one, except the high end is going to be a little bit different, right? Over the 90 trades, right, the account grows to $127,430. So it's a little bit more growth. Again, we are compounding, right? That's a 27.43% growth for the same time frame. Well, when you compound, you're obviously going to potentially make more money. Losses hurt a little bit more because you lose a little bit, but as long as you're doing it smart and you're not over emphasizing risk, it is manageable. So for setup number three, and this is the smaller account. Just to give you a comparison, if you were to trade this at a smaller level, in this setup, we were going to risk 25% of the account value. So trade allocation would be $1,500, right? And for this one here, you can see that we've had phenomenal growth. Over 90 trades, it went from the initial $5,000 to $13,747.
Yep.
That is a 174.9794% account growth. So that means the account basically almost tripled in that time frame, which is pretty staggering, right?
Yeah.
When you think about it.
Yeah, that really is kind of crazy. But that is like Vance talks about it too. Like this is as aggressive as I think any options trading should be.
Yep.
Granted, you see a lot of stuff on Wall Street Bets. You'll see it all over where people are putting their full account into trades. Just know any trader that does this for a long time isn't doing that because your decision making is heavily skewed when you have all your money at risk. Your emotions are probably through the roof, so you can't see straight, you can't sleep at night. So that's one thing, is like you really have to be able to stomach setup number three if you're an aggressive person. Personally, like setup 1 to 2 is more of my style, but if you are setup number three and like to just Jesus take the wheel, you're with a lot of stuff that you do, right? This is very aggressive.
Right.
This is what you should expect to kind of see, and like even your drawdowns, right, should be where your account was 7,500, and maybe the next day, like on just a tiny stop loss, is gonna put you down like $500-600, you know.
Right.
You're aggressively allocating. So that's another thing to take into consideration.
And for sure what you were saying, and just to be, fully transparent, right? I'm not saying that you should ship 25% of your account every single time, right? A lot of risk is based on account size, right? Going 25% in on a $100,000 account is $25,000. That's a lot of money, right? Going 25% in on a $5,000 account is $1,500. Usually people with a smaller account, right? The only way to really grow it is to, unfortunately, risk a little bit more money. It takes money to make money, right? So the smaller your account size, unfortunately, the bigger of the proportional risk you have to take to get it to a bigger point, right? So it's the unfortunate truth of the math of the situation, right? So because in a perfect world, right, when you start up an account, in a perfect world, you never have to add to it with your own personal funds, right? You go into it, you say, here's $5,000 I'm going to trade and invest with, and through your skill and acumen, you're able to grow that, to $100,000, and you're like, look, mom, no hands, I never added a penny to this account.
Yep.
Does that realistically happen for everybody? Probably not, but that's the idea behind it, right? So that's where this comes from with the higher allocation level, you know. So at the end of all of this, what are our key takeaways, right? So the first key takeaway, and Logan brought this up before, is that for the same time period of our 90 trades, which was the end of May to December 1st, the S&P 500 was basically flat. It had a minus half a percentage point return, right? As opposed to, you know, the 25% gains on a smaller account, right? Or a larger account, excuse me. Well, let's say that you didn't have $100,000 or even $5,000 to your name. Let's just say you had next to nothing. If you just traded one contract in risk, $500 in risk, one contract every single time, over the course of those 90 days, you would have made a 325% increase in your account. That's without compounding. That's just trading one contract every single time, right? If you only traded $1,500, which would be 3 contracts, right? You would have increased your account $647 and basically $6,500, right? A 350% return on your investment, right? All of this was done by limiting risk, by using intelligent market situational awareness, by not placing silly delta-based iron condors, by not having stop losses, automatic stop losses, but rolling and taking profit on winning trades to help increase positive expectancy, right? And that's one of the things that isn't talked enough is that it's not just the win rate, right? It's when you win, do your winners cover your losers, right? Because you can have a 99.9% win rate, but if you only make $1 per win and then your one loss, right? That one loss out of 10,000, you lose $1 million. Well, your winners don't cover your losses, right? So that's the big part of this, is that the trades, the winners make money and the losers don't lose a whole lot of money. And we roll to help control the loss and risk of capital. So,
and that's
the closing thoughts, sir. Oh, go ahead.
I was gonna say, as we go into the closing thoughts, that's one thing where it's like, when we talk about condors, let's say we did roll a trade for a 40-cent debit, but then we were able to hedge it with a call credit spread that got an 80-cent return, right? So that's, or sorry, 80%, 80-cent return on that position. That's going to help cover your debit, which is also then going to reduce your risk of max collateral at risk, right? Like from your initial position. So that's another thing that you should definitely think about, is you always have the ability to hedge with a condor. And that's also why we don't start with a condor, is because we would like that to be our hedge. And treating hedges are a little different than treating actual trades. So, and we can go into that in a different video, of course, not this one, but yeah, let's jump into the closing thoughts.
Yep. So the first main one is always, no matter what you're doing, you need to maintain account and trade discipline, right? You need to have a plan going into your trade. You know, whether you're doing a low expected move type trade, whether you're playing a momentum trade, you need to have a well thought out plan. Why am I entering? How am I going to take profit? Where am I going to take profit? Where am I going to stop out? Right? You need to follow your plan and you need to have trade discipline. That includes not being overly emotional. If you are getting overly emotional because of the fact that your trade is in the red, I question if you're trading too much of your account value, right? I'm questioning if you're trading too much account value that's emotional, right? You know, maybe you have a $10,000 account, but $1,000 of risk scares the crap out of you because it's 10%, right? So then maybe you need to trade one contract, right? But you need to know that about yourself, right? Logan talks about this all the time. I'll let him mention this one here. Proper sizing.
Yep. So with proper sizing, and this is one that we see happen quite a bit in the Discord, is like a lot of people will be stressed out over every little tick that the S&P does. And that's what the strategy is for, is to not get stressed over every tick, right? But when you are oversized and you should only have 5 contracts, and maybe you normally do 5 contracts every day, but the one day that you put 15 on because you're that confident is the day it's going to go against you. And the reason why I stress proper sizing so much is because of the emotional awareness of yourself. Once you're emotional, your decision making becomes extremely skewed. It becomes just this whole mess of everything's going to irritate you, right? Like you could have a really good buddy who's really nice to you at that moment. You completely shift how you perceive what he's saying because you have this external emotional thing. And it could be the markets, right? You could be hanging out, right? And then all of a sudden the market goes against you and now you're not present anymore. And that's a really big issue. You can't make decisions. And if you're under the analysis paralysis, you can't do anything except make a decision that later you're going to look back on and say, I wish I didn't make that decision. Even if it worked, because if you get lucky, right, and it works out, that is based on hope. And hope is not a great strategy a lot of the times in the market. So anytime that you're not properly sized, just know your decision making is going to become skewed. So you're going to see more volatility in your portfolio. And I would assume that's the last thing that anybody wants. So just stick to the long term with this stuff, because even just getting a decent return of like 25% on your account over 6 months is still outperforming the S&P, right? Like there's very few things that you can do with such a low amount of your port at risk to get that return and not have to be a great stock picker, right? Like to be the guy who didn't invest in Tesla and then it eats you alive at night. Like all of that needs to be thrown out the window. If you want to be a good stock trader, you have to throw that garbage out the window. And you have to start with where you are right now and take that for what it is and just start the process of doing everything the right way. And then over time, your trades will take care of themselves when you look at your port a year from now, instead of trying to guess the direction every single day, as far as like buying naked calls or puts based on what you emotionally felt was right. That's going to be the largest, everybody knows somebody who has full sent their account into a naked call because they felt that confident, and then the market went the other way because your emotions are going to trick you. So that's everything on proper sizing for me.
Yep. A properly sized framed argument.
Yeah, thanks.
I harp on this all the time, and this is a very important thing, is don't chase entries, right? If you want to make a trade at a certain price point, stick to that price point, right? The entry that you get into a trade, the entry value you get into a trade is just as, if not more important than the strikes you pick. Because if you are going to trade with a stop loss, right? Let's say you're going to trade with a 3x stop loss, the difference between a 30-cent entry and a 50-cent entry is massive, right? It's massive because your stop loss gets triggered that much faster, right? So don't chase entries, right? If you want to get into a trade and your entry is 35 cents, you put it on. If it doesn't fill, you leave it on, right? If it never fills, it never fills, then you missed out. And that's not to say, you should have a boohoo session, right? But when you start to go, oh, I want to get 25 cents for it, or I want to start moving closer, to get that 35 cents, those are the situations where then, if the trade does go against you, right, you got less capital going in. Even if you win, you're going to make less money because, you got less to get in, right? Mm-hmm. So don't chase entries. The other side, and again, this is something that I think is not talked about enough, is don't chase exits, right? If you have a level that you want to get out, set it and get out of the trade, right? Because what happens is there's two ways that people chase exits. The first way is don't worry, it'll come back, right? When the trade price hits $1.50, I'm going to do something. And then it hits $1.50, and you're like, nope, it'll come back, right? Or if you're going to say, okay, when it hits this level, price level, right? So if SPX hits 4,000, I'm going to manage the trade. right? It hits 4,000 and you're like, nope, I'm not going to manage it. It'll come back, right? You can't do that. If you have a rule, follow your rule. The other side where you see it, right, is where people are winning. And again, like Logan said earlier, it's 12 o'clock in the afternoon. There's 4 hours of trading left. The price to debit to close is 5 cents. Now I'm gonna let it sit all day and let it expire worthless because I don't want to give up $5, and maybe another $1.50, $2 in fees, right? I want to give up $7 on my trade, right? If you didn't chase your entry, right, and you got in at a decent entry, what's $7? It's nothing, right? Even if it's 10 contracts, right? You've made far more money than what you're giving back, right? So don't chase exits, don't chase entries. And the last key point, and this is to the Wall Street bettors of the world, right? And this kind of goes with everything else we're saying, which is don't fall victim to the diamond hands mentality, right? Paper hands, which is the opposite of diamond hands, are almost always profitable hands, right? And this meshes all these other things together, right? Too often you see I'm going to ship the whole account. I'm going to try to make $1 million in one go. And then when it goes against me, I'm out and I've got nothing left, right? And don't do that, right? Maintain discipline, use proper sizing, get a good entry, get a good exit, walk away from it, and you've made money. And if you do that consistently over time, A, it becomes easier, right?
Oh, yeah.
But B, what you're going to find is that it takes the emotion out of it because you've become the algorithm. Your trading is literally algorithmic trading, but you're not a computer. You're just trading like one, right? Because you know when you're going to enter and you know when you're going to exit. And if you do it every single time the same way, you get really good, and it's just like any other skill. And that covers it from my end.
Yeah, same here. I just want to wrap this up really quickly by saying I appreciate you coming back on, Vance. And for anybody who was, new to the channel, leave a like, a comment below, subscribe. If you guys would like to come trade with us, the link is below in the description. Vance mentions having a YouTube channel soon, and I'm really excited for that as well. So I just want to do a quick little wrap up, as I always do in the videos, as this is a longer one. So I really appreciate everybody sticking through, and we'll have the spreadsheet linked below in the description if you want to go over every trade. And you could also go back test all of those trading days if you're like someone who doesn't believe that we're actually doing this. You could come ask everybody in the Discord. But just if there's something that you're worried about in that space, like I go over the account statements literally in my videos. I don't know any other traders that really do that. So I would say, just in general, I appreciate you guys watching, and I appreciate you coming back on, Vance.
Not a problem, Logan. Not a problem at all.
Sweet. Well, we'll see you guys in the next video, and that is everything for us today.